So we're going to do DAIF with Dean, drafting and interpreting financial statements. So session 1. So some of what we're going to hopefully look at, a little bit of an introduction to the drafting and interpreting financial statements unit, and then dig into it a little bit by looking at some of the legal and regulatory frameworks that underpin the unit. Look at the conceptual framework for financial reporting, which is quite a key thing, and then talk a little bit around some of the different types of business organisations, which is knowledge that if you've done level 3, that's knowledge you'll already pre-existing knowledge, but it's always good just to refresh some of that as we go through it. So all the resources, generally the resources I use are aligned to Kaplan's resources. So there's some copy and paste out of Kaplan stuff, and there's some of my own spin on it as well. So we'll get started with slide number 1. So purpose of what we're doing then, the purpose of the overall unit, to learn how to produce financial statements of a single limited company and groups of companies. So there's almost, on the actual exam, which we'll come to in a minute, there's almost task 1, task 2, which is around being able to produce financial statements for a single limited company. And then there's task 5, which is consolidated financial statements, so group of companies. So that's a key part of the exam. Next part that we need to look at is understand how to analyse and interpret financial statements by the means of ratio analysis. So ratio analysis has been introduced in various units at level 3, so financial accounting, preparing financial statements, so FAPs, and then management accounting techniques unit at level 3 introduces various concepts around ratio analysis and asks you to calculate certain ratios. And then the third sort of key area of the unit is to obtain a proficient level of knowledge and understanding of these things known as international accounting standards. Now, that's something that lots of students struggle with because it's a concept that, it's quite theoretical, and there's quite a lot of accounting standards. So it's something that generally people can struggle with. But hopefully I'll be able to, talk you through some of that over the course of a number of sessions we're going to do in this area. Next slide, which looks at the syllabus for drafting and interpreting financial statements. So this is directly out of Kaplan's resources. Understand the reporting frameworks that underpin financial reporting. So it's around 7% of the marks for the unit. Drafting statutory financial statements for a limited company. There's an awful lot of marks there. Around 43% of the allocation of marks is for the drafting of statutory financial statements. 25% around drafting consolidated financial statements. And then finally, the remaining marks around interpreting financial statements using ratio analysis. Right. The exam itself then. So what does the exam itself look like? So the exam itself, it's computer-based, as we all know, and nothing that we're not used to in that space. 7 tasks, 2.5 hours, results within 4 weeks. So there's nothing there that we are not used to. That's just everything that we're used to from our existing exams. All level 4 exams currently, results within 4 weeks. All level 4 exams, with the exception of the applied management accounting exam, are 2.5 hours. They're all computer based, as all AAT exams are, and it's 7 tasks. So let's just step into some of the key content then. So if we start to look at the concept of legal and regulatory frameworks. So some of what we're going to talk about is almost our legal frameworks that underpin financial statements, because we're stepping into a world now we stepped out of the level 3 world into the level 4 world, and we're now not looking at sole traders anymore. We're looking at limited companies. So there's some legal frameworks that control the preparation of financial statements for limited companies. We're going to look at what they are. And then we've got the whole concept of accounting standards. Yeah, so there's a bunch of accounting standards that we need to follow when we're producing limited company accounts. Remember, back when we're doing sole trader accounts, there is really no legal requirements and there's no accounting standards as such. You can do it on back of a cigarette packet, or you don't even have to do it at all if you don't want to. The only legal requirement is to be able to complete a tax return. So legal frameworks then. So in terms of limited companies, it consists of two things. One is the Companies Act 2006, the key piece of government legislation, which applies to all UK companies, regardless of whether or not they are following UK or international accounting rules. So you may have, as an example, Amazon. So Amazon UK is a UK registered business. It's registered here in the UK with Companies House. However, from a consolidated point of view, that reports into Amazon Incorporated, which is a US business, and therefore Amazon would follow international accounting rules rather than UK accounting rules. The Companies Act, however, the Companies Act 2006, however, applies to all UK companies, regardless of which set of rules they might be following. So that's one legal framework that we definitely need to follow. And then there could be additional laws and additional legal frameworks that may apply for certain companies, but certainly in companies that are operating in certain industries. So you think about banks, so banks have lots of legal requirements, and financial services institutions obviously responsible to the Financial Conduct Authority, financial regulation. So there's additional legal requirements there that are very much specific to the industry sector in which you're operating. Same as pharmaceutical industry. So I worked in pharmaceutical for a little while. There's legal frameworks there around, the reporting of pharmaceutical trial data, for example. There's lots of other legal frameworks that we might need to be aware of. So that's the legal side of things. So that's very much, you must do this or you are breaking the law. But then there's a whole bunch of requirements that sit within the regulatory space. So it's controlled by various regulators. Not necessarily a law-breaking activity, but, if you don't follow this, it's not necessarily breaking the law, but you are breaking, the regulations and the sort of agreed best practice, if you like. So UK companies, that's the key thing, that UK companies may use one of two approaches. So international financial reporting standards, which are known as IFRS, they can use those to prepare financial statements. And if you're an unlisted company, i.e. you're not a PLC, you could also make use of what's known as UK GAAP. So UK GAAP, and that's GAAP. What GAAP stands for is Generally Accepted Accounting Principles. Now, in the UK, they are published by the FRC, the Financial Reporting Council, and it's a set of agreed best practice, essentially, for the production of financial statements by UK businesses. But importantly, unlisted UK businesses. If you are a UK listed business, i.e. a PLC, you must use IFRS. So if you're a standard limited company, unlisted, you can choose. So we either do IFRS or we use UK GAAP. And anyone that works in this sector might know UK GAAP as FRS 102. Yes, it's Financial Reporting Standard 102 in the UK. But if you are listed, you must use IFRS. which makes a lot of sense. Yeah, there's some links at the bottom of the slides. I will make the slides available as well as the recording. There's some links at the bottom here to a couple of resources that I share with my students that I think are really useful. So the first one here is IAS Plus. They have a publication called IFRS in Your Pocket. I wouldn't necessarily say it's an in your pocket thing because it's 600 odd pages in length, so I'm not sure you're going to put it in your pocket. But what it does is it breaks down each of the international financial reporting standards and gives you, almost the nuts and bolts of what each of the standards is about, what's covered by each of the standards. It's really good resource for anyone studying this unit to get that core understanding of the various reporting standards. And then the second link is just a link to the Financial Reporting Council and their standards around FRS 102, which is essentially UK GAAP. So what is this great big thing called IFRS? Yep, so IFRS, the International Financial Reporting Standards, it's a charitable foundation. So the IFRS Foundation, it's an independent non-for-profit foundation based in the US. Because it's a foundation, it's a charitable organisation, it's got a bunch of trustees. And they appoint the members of what is known as the International Accounting Standards Board. And it's that board, which we'll come on to in a minute, but it's that board that sets the standards, sets international accounting standards. Yeah. So as well as the Standards Board, you've also got the IFRS Advisory Council and the IFRS Interpretations Committee. And overall, the foundation is responsible for the setting and approving of budgets of the various bodies, determine the strategic direction, of course, and the promotion of international standards for accounting. So the drive from most territories is to move towards IFRS. So move away from individual country-specific GAAP, so generally accepted accounting practice, move away from that and move towards one single set of financial reporting standards. That's the drive, and that's the direction of travel. Some people are getting there quicker than others. So obviously, from a UK perspective, we've mandated that listed companies use IFRS. We've not mandated that limited companies go that way, but I can certainly see in the not too distant future, we will be mandating that all limited companies follow IFRS. So the International Accounting Standards Board then, which is very relevant to anyone studying this unit, because you're probably going to get some questions around the International Accounting Standards Board. So what they have is sole responsibility for the setting of international accounting standards. So they're the people that almost take advice from the Advisory Council, from the Interpretations Committee, and they take all that information and develop and formalise the official international standards. So as it says, the board cooperates with other accounting standard setters with the aim of achieving harmony of accounting practice throughout the world. Now, as you can imagine, that's probably quite a difficult thing to achieve. The American market does things one way, we do it a different way. Australia does it a different way altogether. Canada might do it in a different way. The French do it in a different way. And what we're trying to do is trying to get harmony across the world around how financial information should be reported. So the overall objectives of the Standards Board to develop a single set of high quality global accounting standards that require transparent and comparable information in all general purpose financial statements. So it's all well and good having the standard, develop a standard, but then the Standards Board also has a job to rigorously promote the application of those standards and to work with all national standard setting boards, such as in the UK, Financial Reporting Council, to bring around convergence of national accounting standards and IFRS. Now, there is a difference in the UK between UK GAAP, FRS 102, and IFRS. We are starting to see some convergence towards the international standards, but there still is a difference. And it's about working with the national standard setting boards to bring around change that means that ultimately we all converge to one single set of standards. Briefly then, the other two parts of IFRS, the Interpretations Committee, their aim is to assist the overall board, so the Accounting Settings Board, Standards Board even, in the establishment and improvement of the standards of financial accounting and reporting, and it promotes the uniform application of the standards. And then finally, there's the Advisory Council that provides a forum for organisations and individuals to input into the standard setting process. The overall objectives of that are to give advice to the board on agenda decisions and priorities, and to inform the board of the views of organisations and individuals of various accounting standards. Now, one thing that's not on there, but there is almost the talk of the IFRS community, is a sustainability board. So IFRS have very recently set up a sustainability accounting board, looking at bringing around standards on how businesses should report on sustainability. Obviously, sustainability is a huge topic globally, and there's a drive to increase the quality and the standards around sustainability accounting, and make it a key part of the standards. We're not there yet, but we certainly will be there within the next 3 or 4 years, I would expect. And there'll then be a mandated requirement for sustainability reports within certainly listed companies. Lots of listed companies do that today, but it's almost a voluntary thing. I can imagine we're going to get to a point where that becomes a mandated standard. Right then, the conceptual framework for financial reporting. So we're going to have a quick look at that and then finally move on to different types of business organisations. So some of the things I want to look at in this part are around the objectives of financial statements. So why do we produce financial statements? What's the overall objective? Just explore a little bit around some of the users of financial statements and why they would use financial statements. And then we're going to look at the concepts of qualitative characteristics and the various elements of financial statements, and hopefully provide you with some good answers for the exam if it asks you about different elements of financial statements. And then finally look at some recognition criteria for how we recognise various things within financial statements, what you recognise, what you don't. So the conceptual framework then. So this is published by the IFRS. So the conceptual framework for financial reporting, more commonly just known as the framework, outlines the principles and concepts that should be used when developing or applying IFRS standards and IAS standards. Now, someone's going to say, what's the difference? Yeah, they're almost both come from IFRS, but IFRS is the new terminology. Yeah, so IFRS, International Finance Reporting Standards, IAS, International Accounting Standards. Yeah, so as the international accounting standards get rewritten, they're becoming IFRS standards. Right at the bottom of this slide here, I've got a link to the actual conceptual framework for financial reporting. So that's just a link to the IFRS website showing you what the conceptual framework says, the full document, warts and all, the whole thing. So the objective for financial statements then, lots of people have lots of views on this, but the official answer, or the textbook answer really, is to provide information on the financial position and performance of a company that is useful to a range of users. So we think about what we know to date. We've got a statement of financial position, which tells us all the information about the financial position of the business. And then we've got a statement of profit or loss, which tells us about the performance of a company in a period of time. And what we're saying is, it's all well and good having those statements, but those statements then need to be useful to a range of users. And if we can do all that, we've met the objective of producing them. Yeah. So the overall objective to provide information on both financial position and performance that's useful to a range of users. Because if it's not useful, what's the point in doing it? So I just want to explore some of the users of financial statements and some of the reasons why they, or their particular needs for that information. So think about investors. Investors want to look at financial statements in order to be able to make decisions about the buying, selling, or holding of certain stock. So if I was to go and invest my hard-earned money in, say, Tesco's shares, I would want to look at Tesco's financial statements to understand whether or not it's a good idea me investing my hard-earned money in Tesco's stock. Or if I'm an existing investor, I might want to look at the financial statements to understand, is now a good time to sell my stock? Yeah. Is it a good time to buy more stock? Or do I just stay where I am? Yeah. And just hold the stock for a period of time. Lenders. So lenders, typically banks. Yeah. They would want to look at financial statements to understand whether or not to provide a loan or other forms of credit. Yeah, so you definitely banks are quite, very risk adverse, banks generally. So they want to understand what the risk is. So they want to look at, how much debt you've already got in the business. So what's your debt to equity ratio? They want to understand what's the level of return within the business. So what's your return on capital employed? What's your, what level of profit do you have? They want to understand all that so they can make an informed lending decision. Other creditors, they're going to want to decide on whether to supply goods to that business on credit and what the terms of the credit would be. So it could be that they look at your financial statements and say, you know what, actually you don't have any money. Yeah. So we're not going to extend any credit to you because it looks like you're not credit worthy. So we're going to require you to pay up front. Or it could be that they look at the statements and they go, we're prepared to offer credit, but only this amount of credit. Again, creditors, not quite as much as banks, but they generally want to understand risk and manage that risk. Yeah, so nobody would just lend someone an unlimited amount of money. Yeah, everybody needs to understand the risk and then make a decision around what's a sensible amount of risk to take. So more users then, well, the government, those people that none of us like, because they use the figures from financial statements in order to calculate the correct amount of tax that's payable by that business. Employees, so as an employee of a limited company, you might look at the financial statements to assess the position of the company with regards to both suitability for a job. So if you're looking for a new opportunity, a new job, you might look at the financial statements to understand, well, what's the financial health of the business and is it something that, you want to get involved with or not. And equally, you might look at the financial statements if you're already employed by the business. You might look at that to understand what opportunities there might be for your growth within the company. So if you can see that from the financial statements and financial reports that the business is expanding, that could therefore mean increased opportunities for you to expand with the business. And then the public generally, they use financial statements to obtain information about companies of interest. Yeah, so if you've got a particular interest in a particular business, you can go and look for the financial statements of that business and understand a little bit more around their financial performance and their financial health. Right, the next thing then is this concept of the qualitative characteristics of useful information. So anyone who's done level 3 will have seen this before. So the conceptual framework on financial reporting, that outlines 2 fundamental characteristics of useful information and an additional 4 enhancing characteristics. Now, what the framework says is that anyone preparing financial statements should attempt to maximise all of the characteristics for the benefit of users. Now, I think some of the enhancing ones, I think personally, are closer to being fundamental, but we'll go through them. So, the fundamental characteristics, the two fundamental characteristics, one is around relevance. And what we mean by that is it must be capable of influencing decision making. Yeah, so it needs to be relevant to decisions we're hopefully going to make, and it needs to be capable of influencing decision-making processes. The second concept's around faithful, or the second characteristics around faithful representation. So what we really mean there is that it should be the complete picture. Yeah, so all of the information shouldn't be excluding any of the information. It needs to be neutral, i.e., free from any bias. Yeah, so it's not, you're not selling a better picture than you should be presenting. It's a totally neutral picture and free from error. Now, it does say in all the books, it does say free from error. That's a bit perfectionist in some ways, and that's generally me. I would like to produce financial statements completely free from error. However, back in the real world, what we really mean by that is free from any material errors. So anything that makes a material difference. Yeah. So if you're producing the accounts for Amazon, if they were out by £5, it really wouldn't matter, would it? It would not change any decision. Yeah. Because we're talking about £5 in, tens of billions. However, if you're a much smaller business and say your annual profit was £10,000, if it's out by £1,000, that makes the world of difference, and it would change the decisions you make. So it's about it being free from material errors. Enhancing characteristics then under the framework are around comparability. So this is a big one for me. Yeah, you should be able to compare between different entities. So, for example, if we get financial statements for Tesco's and we get financial statements for Sainsbury's, we should be able to say, is Tesco's performing better than Sainsbury's, or vice versa? And then you should also be able to do the same thing for any one entity over a period of time. Yeah, so if we take Tesco's financial statements for the financial year 2024 and compare them to the financial year 2025, we should be able to make some sort of level of comparison between the two. Verifiability. So what we really mean there is it helps to provide assurance regarding the reliability of information. So what that means is that we can verify all the information that's in the financial statements. So what that practically means is that financial statements are, as we hopefully know, produced from a trial balance, which is made up of a bunch of accounting transactions, which is made up of a bunch of ultimately a bunch of ledger entries that came from a bunch of financial documents that come from various financial decisions, essentially. So we decided to buy something, so that's a financial decision, led to a sales invoice, or in that case, a purchase invoice. Purchase invoice, that gets recorded in ledger accounts, which then becomes a trial balance, that then becomes a set of financial statements. And it's about being able to verify where that information come from. Yeah, and ultimately having all the source documents. Timeliness is around information being available within an appropriate timescale for decision making. So to use a really balmy example, it is no good me producing a set of financial statements for financial year ending in March 2025 and giving them to you in March 2030, because that's not an appropriate timescale for you to make any relevant decision, is it? So we should be quite timely. Now, we'll talk a little bit around what the reporting timelines are in a little while, and then I'll give my view on whether I think that's too long or not long enough. And then finally, the final enhancing characteristics around understandability. Now, this is something that I spent a lot of time really focusing on when I worked in the big bad world, and almost what I spend a lot of time working on, in terms of management reporting, in my my education job at the college, is being able to provide information in a way that's understandable by the people that are using the information. So, as accountants, we're very good at understanding numbers, but not everybody's an accountant trained, are they? Not everyone has done an AAT qualification or indeed any other accounting qualification. Some people, whose level of financial literacy is quite low. We need to be able to provide the information in a way that's understandable to the people that are using it. Now, you may say, well, aren't all these things linked? Well, they almost are, because to get comparability, you need a standard, because unless we're doing it in a standard way, you're not going to be able to compare things, because last year's a lot different to this year's. It'll be prepared in a different way, and you can't compare. So comparability is about having a standard. If we've got a standard and every set of financial statements is prepared to the same standard, that aids understandability, because you've only got to understand it once. Because once you understand the framework and the way the statements are prepared, you understand all financial statements if they're all prepared to the same standard. Yeah. So there is some link between certainly those enhancing characteristics. I would argue that understandability is a fundamental characteristic. If people can't understand it, it can be the most relevant thing in the world, and it can be the most faithful representation of the truth. But if no one understands it, no one's going to use it. So I'd argue understandability is a fundamental characteristic, but I'm not writing the framework. Yeah. Now, one thing that's really important is the underlying assumption when we prepare a set of financial statements here in the UK. The underlying assumption behind all financial statements is that the business will continue in operational existence for the foreseeable future. So at least the next 12 months. Yeah, without either the need or the intention to cease trading. So when you're putting, which is known as the going concern principle. Yeah. So when you're putting together your financial statements, if you become aware that there's no money in this business, and therefore it's not going to operationally exist in 12 months' time, within the next 12 months, then you shouldn't be preparing the financial statements in the usual way. Because, for example, no point valuing the assets at net book value, or carrying amount, because you're going to have to get rid of them. Because the business is not going to exist. So all the assets are going, aren't they? Yeah. So you're not going to value them at a carrying amount in your accounts. You're probably going to value them at what you realistically can sell them for example. Yeah. And it's important to say it's either a need or an intention. So if you're made aware from, directors of the business, it's their intention to cease trading in the next 12 months, then they're not a going concern. And there's a difference, preparation standards around that. So the various elements of financial statements then. So these are the things that hopefully we all know. Yeah. However, there's almost some really nice textbook answers at the side around what these things actually are. So certainly at level 2 and level 3, we've talked about every single one of these things. But we almost talk, certainly at the lower levels, like level 2 and level 3 to a certain degree, we talk about assets as being things that we own. And we talk about liabilities, things that we owe. Yeah, well, when we get to level 4, we need to be a little bit more scientific than just, well, an asset's something we own and a liability is something we owe. Yeah, so an asset, the textbook definition from IFRS of an asset is a present economic resource controlled by an entity as a result of a past event. So if we break that down a little bit, a present economic resource. So as it says underneath, an economic resource is the right, it is a right, that has the potential to produce economic benefit. So a present economic resource, so you've got something and you've currently got that within your business, you've got something or a right over something, that has the potential at least to produce economic benefit. So what we mean by economic benefit, it's going to make you some money. So think about, take a van that we bought. So we're a courier business. We bought a van. So we have the van. The van sat in our car park. So we have a present economic resource. So we have a right to use that van, and that van, because we're a courier business, has the potential to produce economic benefit. Because without that van, we can't deliver parcels. Without parcel deliveries, we don't have any revenue. So it has the ability to produce economic benefit. It's controlled by the entity. It's our van. We control it as a result of a past event. The past event is we bought the van. So it sounds like a lot of words, but really it makes a lot of sense. Present economic resource controlled by the entity as a result of a past event. That's the definition of an asset. A liability is almost the opposite. Well, it is the opposite. It's a present obligation, a liability of the entity to transfer an economic resource as a result of a past event. Now, what it doesn't say is a present obligation of the entity to transfer cash as a result of a past event. Because liability doesn't necessarily need to be settled in cash, does it? An economic resource is something that's got potential to produce economic benefit. So we could give them cash. Here you go. Here's a lump of cash to discharge our liability. What we could also say is, well, here's one of our assets. So here's one of our assets. We'll give you that asset in exchange to discharge the liability. Or we could say, well, here's some equity. Here's an equity stake in our business, which is an economic resource, something that has the potential to produce economic benefit. You can have that. So a present obligation, because we've got the obligation right now. So we've got a liability to pay some money or to discharge a liability right now. It's a present obligation of the current entity. To transfer economic resource, so anything that's got the potential to produce economic benefit as a result of a past event. Well, we did something in the past that created this liability. So whether that's, buy some goods from a supplier, whether that's take on some debt, whatever it was, it happened as a result of a decision we made in the past. So those are what you usually get on this exam is you get a task that's around IFRS standards, and it typically will ask you, in your own words, please define what an asset is. And you'll get a couple of marks for defining what an asset is. Or what's a liability. Get a couple of marks for that. Equity then. So at level 2 and 3, equity is, well, if I sell all my assets, pay all my liabilities, it's what's left. Well, that's exactly what it is. But to use a bit more of a textbook answer, it's the residual interest in the assets of the entity after deducting all liabilities. So it's what your interest is in the assets of the business after you've deducted all liabilities. And hopefully equity will be positive, won't it? Hopefully. Hopefully you've got more assets than you've got liabilities. Income, quite simply the increase in economic benefit during an accounting period, and expenses a decrease in economic benefit. So all of that is nothing you didn't already know. It's just different words. It's just different words to explain what you already know. Right. So what do at level therefore, what do the key financial statements look like? Again, there's some slight differences which we're going to talk about, but ultimately, a statement of profit or loss, believe it or not, shows exactly that. Summarises the effects of trading. Yeah, so income and expenses, and therefore shows the financial performance of the business for a given period of time, which typically would be 12 months. Yeah, but doesn't need to be the last 12 months, does it? You know, you could produce a statement of profit or loss for a quarter, yeah, for a 6-month period, for a month, yeah. But typically, certainly from a statutory point of view, it's going to be a 12-month period. It also includes items of other comprehensive income, this is a new level 4 concept, something we don't talk about level 3, yeah. But other comprehensive income, such as revaluation surpluses, which we will talk about in future weeks. We'll touch on a little bit, but we'll definitely explore more as we get deeper into the content. The second financial statement I want to talk about is the statement of financial position. So again, it's nothing new to you. It presents a snapshot of the financial position of the business at a specific moment in time. And it summarises assets and liabilities. Yeah. Now, there's some subtle differences to these statements. Yeah, because we're now dealing with limited companies and not sole traders or partnerships. But fundamentally, they still contain the same information. Yeah? A statement of profit or loss, income minus expenses shows profit. Statement of financial position, assets, liabilities, capital or equity. Yeah. So we're just going to show you what the statement of financial position looks like for a limited company. Yeah. Now there's some words on here which will all be new. You won't have seen before, potentially. Just a slightly different way of categorizing things because we're now following a set of financial standards. So statement of financial position, yeah, we should start with listing out our non-current assets. Now, non-current assets from a limited company perspective, certainly in the UK, are made up of what's known as PPE, property, plant and equipment, not personal protective equipment. Property, plant and equipment. So if you think about what that is from a non-current asset perspective, property, any property we own, plant, that's vans, cars, forklift trucks, bikes, motorcycles, all that stuff. And equipment is pretty much everything else. So computers, yeah, racking systems in a warehouse, conveyor belt systems, all the other equipment that you might be holding that's a non-current asset. Property, plant and equipment can broadly be classified as tangible assets. Tangible in that we can see them, touch them, yeah, and we can physically see them. They've got physical substance. Intangible assets, which is the next part of non-current assets, are all those non-current assets that don't have physical substance. So broadly speaking, things like goodwill. Yeah. So goodwill, you can't see it, you can't touch it. Yeah. You can't put it on the shelf. Yeah. Patents, copyright, trademarks, all of those things have value. Yeah. But you can't separate. So for example, think about Coca-Cola, for example. Yeah, Coca-Cola. The brand Coca-Cola, the actual brand name Coca-Cola, that's got value. Yeah. But you can't separate that from a can of Coke. Yeah. So it's the brand, the trademark around Coca-Cola is very much an intangible asset. It has value, and potentially you're going to recognise that as a non-current asset. The current assets, nothing new there. Inventories, yeah, trade and other receivables, cash and cash equivalents. So they're just different words for what you've seen before. So inventory, yeah. So the other key thing is if you're going to do this properly, and I don't think AAT doesn't penalise you for putting things in the wrong order, but really current assets should be in reverse liquidity order. Yeah. So the least liquid first and the most liquid at the bottom. So the least liquid of your current assets is your inventory, because you've got to sell your inventory to either create cash or trade receivables. Yeah. So if you were running out of money, yeah, then the first thing you'd do is you'd empty your bank account, the cash and cash equivalent. So that's the most liquid of your assets. The second most liquid thing would be trade and other receivables, because you could ring all your customers up and say, "I need the money today." Yeah. So that's, and then obviously trade receivables is then converted into cash, which becomes very liquid. Inventories need to be sold and turned into either trade receivables or into cash. Yeah. So they're the least liquid. Trade and other receivables, so that's just literally, like I say, that's the money you're owed from your customers. Yeah, that is a current asset. There are some other receivables, but we'll jump into in future weeks. Cash and cash equivalents. Cash is just literally cash you've got in the bank, so that's the bank, or physical actual cash. They might have some petty cash. Yeah, and cash equivalents, there are some things that are considered to be cash equivalents, which we'll, again, jump into in future weeks. So you can add your non-current assets to your current assets to get total assets. Equity. Now, equity section of a statement of financial position for a limited company looks very different to what you've seen in sole traders. In the sole trader world, yeah, you've got capital, drawings, profit in year. So, just your profit you've made in the current year. So the profit you've made in the current year then becomes part of capital and just moves forward as you through time. What we've got here in the equity section of a statement of financial position for a limited company, the share capital. So what's the value, of the shares? So what's the net book value of the shares? I.e., what's the book value of the shares? Share premium account, which I don't really particularly want to go into in too much detail right now, but that's the premium over the book value. Yeah, so if you sold shares, so say the book value of the shares are £1 each. If you sold them for £2 each, yeah, you've got £1 of share capital and you've got £1 of share premium. Retained earnings, that's your profit over extended period of time. Yeah, it just gets built up. And it's the money that stays in the business. So it's your retained earnings that forms part of capital. We'll talk about it in future weeks, but you can have things like dividends. Yeah, dividends are a reduction or distribution of retained earnings. And then revaluation surpluses. You can revalue certain assets, and that creates potentially a revaluation surplus. That forms part of your equity and the equity that's within the business. Obviously, it's the same principle that equity must equal the same as your net assets. So we haven't talked about liabilities there, but liabilities are coming next, yeah? So this, at the bottom here, yeah, total equity and liabilities must equal back to net assets, yeah? So non-current liabilities, the only thing you need to worry about non-current liabilities, long-term loans, so bank loans. That's the only thing you're going to need to worry about at this level. Yeah, there are debentures, but let's be honest, there is the concept of debentures, but within the AAT world, it's literally going to be a bank loan that they're going to be looking for non-current liabilities. Current liabilities, same thing. Yeah, trade and other payables, bank overdrafts, tax payable. Yeah, that gives total liabilities. You can then add total equity. You can add your equity to your liabilities to get total equity and liabilities. Nothing massively different there. Just want to talk a little bit about a statement of profit or loss and other comprehensive income. So we start to use official recognised terminology here. So generally, sales is not sales, it's revenue. Yeah. Cost of sales, because that's what it is. Gross profit, so revenue minus cost of sales equals gross profit. We then have distribution cost. So cost of distributing our goods, administrative expenses, so they're all the admin costs around the business. We then get what's known as profit from operations. So what's your profit from day-to-day trading activity? We then take off finance cost, which is the cost of any lending that we've been involved in, to get profit before tax, which is quite an important thing. Yes, that's how much profit we've made in the business before the payment of any taxation. Then we've got the income tax expense, which is more commonly known in the limited company world as corporation tax. And then the bottom line would be profit for the period, and that's what would go into retained earnings. Yep, so once you've got the profit from the period, which was the last bit on the previous slide, you can add in your other comprehensive income. So this is what makes it slightly different, is that this is a statement of profit or loss and other comprehensive income. So the other comprehensive income will be any revaluation gains or losses. To get you to the bottom line on the statement, which would be the total comprehensive income for the year. Now, this note at the bottom here talks about how, compared to sole traders, company financial statements are more formalised. Yeah, and they have to be more formalised because we're following international accounting standards. Yeah, or generally accepted accounting practice. Only certain headings and amounts are required to be disclosed in annual financial statements, the ones we've highlighted or I've highlighted above. And the capital structure of a limited company is presented differently to that of obviously sole traders or partnerships. Talk a little bit around the recognition then of the various elements. So we talked about assets, liabilities, equity, income, expenses. Yeah. So what does the framework say around the recognition of those individual elements? So what it says is to be recognised in financial. The framework says any item should be recognised in financial statements if it meets one of the definitions of an element. So asset, liability, equity, income, expense. If it meets one of those requirements or one of those definitions, yeah, and it provides relevant information regarding that particular element, and it's a faithful representation. So it's got to be relevant and a faithful representation, and it must meet one of the definitions of the elements that were explained on the previous couple of slides previously. If it meets all that, then you should recognise it. Otherwise, you shouldn't recognise it. Yeah. Talk a little bit, for a few minutes, about how we measure the value of the elements. So the framework identifies two ways of measuring the value of assets, liabilities, and the various different elements of financial statements. One is around historical cost, which, as it says, is typically determined by reference to the original transaction price. So assets would be recorded at the price you paid to acquire the asset. Liabilities would be recognised at the proceeds received. Yeah, so what it would cost to discharge. Well, ultimately, what would it cost to what historically would it have cost to discharge that liability? That's one way. The other way is around current value, the price needed to pay now reflective of current market conditions. And then within that world, you've got obviously the current cost. So assets are held at a cost. Assets held at the cost of buying an equivalent asset. Yeah. So you measure the value of the asset based on what it would cost to replace the asset. Liabilities would be carried in your financial statements at the amount that's currently today required to settle them, which could be a different amount to the actual liability. You know, what you actually incurred originally. Fair value, so assets are carried at the amount that would be obtained from their sale. Yeah, so you ultimately, fair value is another word for market value. Yeah, so you would recognise the assets at the amount that you obtain if you sold them, and the liabilities would be carried at the amount required to settle the liability. And then the final way is using this thing called value in use. So assets would be carried at the discounted value of the future cash inflows that item will generate. So you might have an asset that, you know, cost you £100,000, but it might have the potential to be able to generate £1 million of revenue. So it's worth more to you in its current use than it ever was worth, from its historic cost. Liabilities would be carried at the discounted value of the cash flows required to settle them, which could be, a totally different number. I'm going to spin through this quite quickly, this last bit, around different types of business organisation, because I think most people generally already know this, but we have non-for-profit organisations, we have for-profit organisations. Business's primary goal is to make money, profit. Not-for-profit organisations, whose primary aim is not to make profit. So they are people like charities, clubs, societies. Missed a bit out there. That's sole traders. So sole traders are businesses owned and managed by one individual. The owners are responsible for all business debt. Partnerships, businesses owned and managed by 2 or more people. However, the partners are still responsible for business debt unless it's a limited liability partnership. Limited companies classed as a separate legal entity. We have shareholders, that are the owners, and it's managed by directors. The company's finances are separate from those of the owners. Limited liability partnerships, same as a partnership, but some or all the partners have limited liabilities, similar to shareholders. Charities, organisations which meet the definition of a charity, are set out in the Charities Act 2011, established for charitable purposes, which is benefit of the general public. And then public sector organisations responsible for providing public services, so things like NHS, health, education, social care, housing, all the other various things. Final slide, I'm nearly there. A summary of the difference between private companies and public companies. Now, this is an important thing for this exam. You need to understand the difference between public companies and private companies. So public companies, PLCs, private companies, limited companies. So you must be registered to be a public company, and if you're not a public company, you are a private company. Public companies end with PLC or public limited company. Private companies end with LTD or limited, or the same equivalent thing in Welsh. Some companies, like charities, might be exempt from having LTD or limited at the end of the name. Capital requirements, public companies must be no less than the authorised minimum, which is currently £50,000. Private limited companies, no minimum requirement for capital. Of course, you're going to need £1, aren't you? But aside from that, there's no minimum requirement. You're going to need some capital. Public companies can raise capital by selling shares to the public. Private companies are prohibited from offering shares to the public. Yes, you can't, because you can't trade publicly. Public companies can't start trading until they've had a trading certificate from the registrar, the stock market registry, before they commence trading as a public company. Private companies can begin from the date of incorporation, so the date of incorporation on the incorporation certificate. From that date, they can trade as a private company. Shareholders, public companies need 2 minimum. Private company, minimum of 1. The same is true of directors. Minimum of 2 for public company. Minimum of 1 for private company. In terms of your accounts, if you're a public company, you must file at Companies House within 6 months of the financial year end. And private companies within 9 months. I just want to pick up on that point. The main reason for that is a public company is far bigger. It's got more resources, probably got a dedicated finance team. Limited companies come in all shapes and sizes. It could be one person who's the same, and it could be the shareholder and the directors, the same person, a bloke running the local plumbing company who knows nothing about the world of accounts and his requirements financially. Whereas a public company, to get to that point where you're, XYZ PLC, you're going to have a finance team. So the general concept is that you'll be closer to the information, closer to the numbers, and therefore be able to produce them quicker. And then finally, the audit requirement. Public companies, all public company accounts must be audited. So it's a statutory requirement for PLCs to have their accounts audited by an independent auditor. Private limited companies or private companies, they're not required to have an audit if you meet the exemption criteria. So there is a bunch of exemption criteria. However, if you obviously don't meet the exemption criteria, you do require an audit. Yeah, but quite a lot of limited companies don't require audit. Some do, but there's quite a lot that don't.